when you take on venture, you're trying to get, you have to accept this, that you're investors. And this doesn't mean that I want to leave the business as soon as we take on venture or anyone else does, but you have to accept that they are giving you money for equity, a valuation that you're not going to get from a local bank, but they are going to want an exit at some stage. So they want a disproportionate return at some stage. So the rules of the game almost change a little bit. And when we looked at our business, being, as Joe said, a subscription first business, you're also playing in a market where people are playing different games, and you've got, some massive competitors in our space who are raising huge amounts of money, who are buying market share and being in the auctions and pushing up the CPMs and the CPAs. Do I want to be out of this in 10 years? And again, your personal is not always tied to the investor, but you've got to have a real clear understanding that investor has probably got a life cycle on that fund. They've probably got to get a return, and you've got to work it back, because maybe not to go into now, although I'm happy to, but it can also turn different. If you don't have a real clear view and you get into an investment, you can end up being in a worse position than taking the money. Doesn't mean you're going to be successful. It actually ups the risk, and it means that you can have a disproportionately good outcome, but you also increase your chances of potentially not having a good outcome. So you've got to really think that through.